Welcome to this CapitalCraft explainer. Okay, let's dive right into this. If you've been looking at the wealth gap over the last decade, you're probably feeling pretty frustrated, right? And honestly, the data shows exactly why that gap is widening so fast. We're seeing housing costs just completely outpace historical wage growth, and at the same time, inflation is literally eating away at the purchasing power of your everyday paycheck. It's so easy to look at those numbers and feel completely priced out of prosperity. But today, we're going to look at the hard data, the real-world strategies, and the actionable steps that show how everyday people can still build a true financial fortress. You absolutely do not need a six-figure salary to pull this off, and we're going to explore exactly how that works.
Here's how we're breaking down today's explainer. 1. The high salary myth. 2. Recession mistakes. 3. Real estate on a budget. 4. The action plan. And finally, 5. Building a digital asset. We'll start with those foundational habits and end with a concrete, high-leverage action plan.
Section 1. The high salary myth.
Let's kick things off by completely shattering a really common limiting belief that holds so many of us back. It's this idea that you have to be born into money or have a massive executive-level income just to achieve financial independence. The traditional myth tells us that wealth is strictly reserved for six-figure earners. But the actionable reality, backed up by financial planners, is that wealth simply requires a plan, consistency, and time. Experts point out that even with a modest $40,000 salary, you can absolutely build a comfortable retirement if you manage it right. The secret isn't a massive paycheck. It's compound interest. By consistently investing small amounts over 20 or 30 years, those returns begin to generate their own returns, exponentially growing your initial deposits. So it's really not about what you make, it's about what you keep and how much time you give it to grow. That consistency has to start somewhere, and this brilliantly illustrates the 50-30-20 budgeting framework, which is essentially the absolute foundation of wealth defense. Here's how it breaks down. You allocate 50% of your income to your absolute needs, things like rent, groceries, and utilities. 30% goes to your wants, because you still need to actually enjoy your life and avoid burnout. But that final 20%, that is the magic number. That is your savings and investment engine. And crucially, that 20% shouldn't just sit in a regular checking account losing its value to inflation. To actually build wealth, that money needs to be deployed into compound growth vehicles. Think low-cost index funds or high-yield savings accounts. Whether you make 40 grand or 400 grand a year, applying this exact ratio forces clarity into your spending and guarantees you're paying your future self first.
Section 2. Recession mistakes to avoid. Now, before we can talk about aggressively making money, we have to talk about protecting it. We're pivoting to the defensive playbook for a minute because growing your wealth literally means nothing if you lose it all during a market downturn or a sudden spike in inflation. When a recession hits or the stock market drops, amateur investors often panic and make some incredibly costly errors. Financial planners warn against 4 major traps. First up, stopping your retirement contributions out of pure fear. Second, panic selling and moving your investments to cash. Look, if you sell at the absolute bottom, you completely miss the inevitable rebound. Third, borrowing money to invest. When stocks drop, it might seem like this genius time to take out a loan and buy cheap shares, but trying to time the market with borrowed money is like trying to catch a falling knife. You're going to get hurt, especially when your job security might be a bit uncertain. And finally, aggressive debt repayment. Experts point out a really surprising, almost counterintuitive truth regarding that last point. Normally, standard financial advice tells us to crush our debt as fast as humanly possible, right? But in a volatile recession, financial experts actually advise sticking to the minimum payments specifically to protect your cash reserves. Think about it. If you deplete all your liquid cash to aggressively zero out a credit card, and then you suddenly lose your job the very next week, you've completely removed your safety net. You literally cannot pay your mortgage or buy groceries with a zero-balance credit card. Liquid cash is your absolute lifeline during an economic downturn.
Section 3. Real estate on a budget.
All right, our defense is locked in. Let's transition over to the offensive playbook. We're going to look at how low to moderate income earners can actually acquire property right now, even with today's historically soaring housing costs. You've probably heard the term house hacking, but the strategy has evolved significantly. The old way of house hacking usually meant buying some dusty duplex or awkwardly living with 3 roommates and constantly fighting over the thermostat just to help pay your mortgage. But the new house hack is all about maximizing a property's utility without sacrificing your own privacy. Homeowners are now offsetting their mortgages by renting out detached garages as storage, renting out their private pools by the hour, or leasing out a completely separate basement unit. You're essentially turning your primary residence into a cash-flowing business, all without giving up your own personal space. Now, you might be wondering how to actually buy that house when you don't have a massive pile of cash sitting around for a down payment. Well, the reality is that ordinary people are bypassing those massive traditional down payments right now by utilizing very specific loan programs. FHA loans are government-backed and designed specifically to help low to moderate income buyers enter the market. Or if you've served in the military, VA loans offer incredible zero down payment options. USDA loans also offer zero down for eligible rural properties. And hey, there are also low down conventional mortgages. Unlike FHA or VA loans, conventional mortgages aren't government-backed. They're offered by private lenders, but they still provide really flexible options with down payments as low as 3% if you have good credit.
So, the crucial point is this number right here, 3.5%. That's the minimum down payment required for an FHA loan. Let's break down the math on that real quick because it is incredibly empowering. Traditionally, people think you need 20% down. On a $300,000 property, 20% is $60,000 in cold hard cash. But with a 3.5% FHA loan, you only need $10,500. That is a massive difference. And the absolute best part is that you can use that FHA loan to buy a multifamily property. We're talking up to 4 units, as long as you live in one of them. It's an amazing tool for totally bypassing the high barriers to entry in real estate.
Section 4, the action plan. Okay, we've got the theory down and we've explored the financing options, but I want to ask you this directly. How do you actually start landing your very first property deal? It's really easy to watch an explainer like this and just nod along, but we need to know the exact chronological steps to make this a reality for you.
According to the BiggerPockets investing framework, here is the exact chronological sequence to follow. Let's move through this and see how it builds. Step 1, talk to a lender and get pre-approved. This takes all the guesswork out of what you can actually afford. Step 2, define your long-term strategy. Ask yourself, are you looking for monthly cash flow right now, or are you aiming for property equity over the next 5 years? Step 3, educate yourself and research the specific local market you want to invest in. Step 4, find an investor-friendly real estate agent and start analyzing the deal flow. Analyzing a deal just means strictly running the numbers, checking if the projected rental income actually covers the mortgage, the property taxes, and sets aside a solid reserve for maintenance. Step 5, make offers. Don't be afraid of rejection here. And finally, step 6, take the equity and experience you gain from that very first deal and scale and repeat the entire process.
Section 5, building a digital asset. But what if real estate just isn't your main focus? Or what if you want to generate the cash for that down payment through a modern side hustle? The story of John, who was an Irish large animal vet, is a phenomenal example of leveraging new technology. John was completely burnt out from clinical work. In month 1, he moved to Australia knowing absolutely no one, bought a cheap desk off Facebook Marketplace, and just started cold calling local businesses to offer services. By month 5, he dove deep into learning AI web development. And astoundingly, by month 9, he hit $20,000 in monthly revenue, just 9 months to completely change the trajectory of his financial life. It is genuinely so impressive. The crazy part? John didn't have any formal background in tech. Instead, he heavily leveraged artificial intelligence to write his website copy and generate designs, which allowed him to completely bypass years of coding experience. He focused hyperlocally, networking with small business owners, tradespeople, and accountants to build out their online presence. And, crucially, alongside the upfront fees he charged to build the sites, he built $3,000 a month in pure recurring revenue. This recurring revenue came from charging clients ongoing fees for website hosting, SEO maintenance, and regular updates. He essentially put in the reps, embraced AI to get ahead of the curve, and built an incredibly valuable digital business completely from scratch. Now, what's really interesting about this slide is that hitting $20,000 a month wasn't just handed to him. He faced constant rejection on those very first cold calls, but he stayed incredibly disciplined. His story proves that in today's economy, maintaining discipline, leveraging brand new tools like AI, and putting in consistent daily effort can completely override a lack of initial capital or the total absence of a traditional business background. Leaving his clinical burnout far behind him, John concluded, "This is the perfect business." And why is that? Because it offers the ultimate freedom by completely decoupling his time from a specific physical location. He built a sellable asset entirely from his laptop. He can literally fly back to Ireland to visit family for 2 months, and his business just keeps running. Whether it's learning digital skills or investing in real estate, building assets gives you back the control over your time and your location that a standard paycheck simply doesn't offer. So,
we've explored how to defend your wealth, how to bypass the high salary myth through compound growth, how to acquire real estate for just 3.5% down, and how to build a highly profitable digital asset from scratch. The economic gap between those who rely solely on a paycheck and those who actively build assets is widening every single day. The blueprint is right here in your hands. But the clock on inflation and rising costs is continually ticking. So what's it going to be? Will you be a spectator to the wealth gap or an active participant in your own prosperity? Thanks so much for joining us for this explainer, and we'll see you next time.